There's been a lot of talk lately about an inverted yield curve and what that signals for future economic growth. Specifically, does it signal a recession? So what we'll do here is we'll take a quick look at the theoretical underpinning of that, why an inverted yield curve might indicate a recession, and then we'll jump into some actual data and take a look at the historical record and see whether it's that theory is sort of borne out by what we see happening in markets. So the link to this presentation is in the description. And there's also some links to some other presentations. So the theoretical basis of this is a theory called pure expectations. I have another presentation on the entirety of the term structure, also on pure expectations. There should be pure expectations here. Right, starting there. So if you want to dive a little bit deeper, you can go take a look at that presentation. But we'll talk about kind of a high-level quick overview. So what pure expectations, this theory of the term structure of interest rates. Remember, the term structure of interest rates is how interest rate varies given maturity. So the 1 month versus the 1 year, the 10-year, the 30-year interest rates, risk-free interest rates. So what pure expectation says is the yield on a 10-year Treasury note is the average of the expected yields on 1-year notes for the next 10 years. So what this is basically saying is that the 10-year note is sort of an average of what the market expects to happen over all those 10 years. That makes perfect sense, right? But what this means is because we can see the 1-year rate today, right? We can look at what the 1-year rate is today, and we can look at what the 10-year rate is, and that gives us an indication, the relationship of what the market expects to happen over the remaining 9 years. Right. It's a little more useful. We'll talk here in terms of the 10-year and the 5-note rate. So jumping into some numbers here, if the 10-year rate today is 5%, and that's the rate on the 10-year bond or 10-year note, today is 5%. And the rate on the 5-year note today is 2%, then by pure expectations, we expect the 5-year interest rate that will prevail in 5 years to be 8.09%, right? So this is an upward sloping yield curve. The 5-year rate now is 5%, and we expect the 5-year rate in 5 years to be 8%, right? So we expect increased economic growth. Good. This is also how this is used a lot in banking, how we can get sort of an implied forward rate. So you might hear that term. Now, take another example. Let's say today's rate is 10-year rate is 5%, right? So the 10-year rate today is 5%, and the 5-year rate today is 7%. So what this means is the 10-year rate is less than the 5-year rate, so it's an inverted yield curve, right? So what does this say about the expected 5-year rate in 5 years? Well, that's 3%. So in this case, the 5-year rate today is 7%, and the market expects in 5 years the 5-year rate will be 3%. So why might that occur? Well, that occurs when there's a slowdown in economic growth, a recession. So this is a solid theoretical reason why, when the yield curve inverts, that we expect a recession. So there's a lot of things people will talk about in markets saying, oh, well, when this happens, there generally tends to be a bull market, where this happens. And that could just be empirical, something that people see often with not much theoretical underpinning. But the idea here, the takeaway you should get from this is that there is a strong theoretical reason why, when the yield curve inverts, that is the market saying we expect there to be a recession. Now, note that is the market saying I expect there to be a recession. The market can be wrong, and there is not a recession, right? But it is a solid reason why, if it inverts, then yes, the market is expecting, hey, I think there's going to be a recession. Good. So that's the theory. Let's look at the actual data, and if the yield curve, it'll be slowing economic growth. I have this calculator here in case you want to. Actually, I have to get it off. To put in rates and then see what the expected 5-year rate in 5 years is. So here's an interactive app. This will always, whenever you open this, it'll pull the latest data. So this will always be up to date. And what I have here is recessions in this sort of pink color. And these are the various interest rates. So let's go maybe to 2008, right? So what we can see here, well, let's talk a little bit going back. What you can obviously see is before a recession, it looks like the yield curve flattens, meaning the yields become somewhat similar. You see this fairly regularly going back into let's go back to the 60s here, 1960s. So you see it's flat, and then when the recession happens, the yield curve uninverts, and then it kind of gets flatter and the yield curve uninverts. So going to 2008, right? So that was the most recent large crisis. In the 2000s, the yield curve is upward sloping, right? So we see the 1-year rate is 1.24%, and the 30-year bond rate is 5.08. No, this is the yield curve, which is a little different than the term structure, right? So, but the yield curve is, we're using that as an indicator of the term structure. So what happens going into 2007 is we get an inverted yield curve, right? So here we have the 3-month rate at 5% and the 30-year rate at 4.87%. So that's, it's slightly inverted, and it's basically the yield curve is flat. And then we get a recession shortly thereafter. Now, what happens here is that the Federal Reserve generally tends to drop interest rates quickly, right? So in this period from May 2007 to April 2008, note the stock market is going down in this period. It hasn't hit the sort of real crash. The real crash in the stock market is what you're starting to see here. But yeah, so while the stock market starts to decline, and while it becomes clear we're in a recession, the yield curve uninverts fairly quickly because short-term rates decline, right? So here we're inverted June 2007. By the end of the year, we're see, are we inverted now? We're slightly inverted. Federal funds 4.24. The 3-month is 3.07. So by about this time we're still slightly inverted on the short end of the yield curve, but the long end is uninverted, right? So is upward sloping. And then, if you remember, I remember, but the crash was largely September, October 2008, right? And that's where you see this very quick decline. So once the stock market really started crashing, the Federal Reserve dropped the federal funds rate down to 0. This is an effective federal funds rate of 0.39 over the period, but then you have the 30-year at 4%. So the yield curve uninverts, right? So yes, what we generally tend to see is during a recession, the yield curve is not inverted, but going into a recession, right, we can go look back to 2000, and we get a flattening yield curve. Let's see, it's inverted here. The 6-month is 6.25, 30-year is 5.83, right? And then we go into the 2000 tech bubble, right? And then the yield curve sort of quickly uninverts again. So generally speaking, 1990. So this is 89. What do we have here? Federal funds at 8.28, 8.56 on the 30-year. So we're in a flat yield curve, maybe not necessarily inverted. Then we go into a recession, and then it uninverts fairly quickly. So and one other kind of interesting one to talk about. We can go look at COVID. This was one of the market participants, we were talking a lot about this. It wasn't so much in the news, but going prior to COVID, it looked like we were going to go into a recession, right? So when was COVID? It was 2020. So here we're looking at 3-month, a 1-year of 1.8 and a 30-year of 2.16. So this is a pretty flat, it's still somewhat upward sloping. Well, the 7-year was at 5 years at 1.57. So from the 1 to the 5 years is inverted. So it looked like we were going into a recession, even if COVID didn't happen. And then, however, COVID happened. The Federal Reserve again dropped interest rates to 0, and then the yield curve became sort of uninverted. So So that is somewhat interesting. Like I say, a lot of people thought we were going into recession. So now the question is, what's going on now? Do we have an inverted yield curve? So what is this? This is bringing in August 2024. I wonder why this should have somewhat later data than that. I have to check to make sure it's bringing in. But as of August 2024, we were at 1 year was 4.43, 30 years 4.15. So we're, again, a pretty flat yield curve. That's inverted. So yeah, we'll see if it works again. Now, what this is basically saying is the market is giving us a signal that, so this doesn't include the recent 50 basis points cuts from the Fed. But what this is saying is the market certainly thinks that, I'm going to reload this. The market certainly thinks that we might be heading into a recession, and is pricing that in. Whether it happens, again, the market can be wrong, right? So that's not to say that we absolutely will go into recession. It's just that, as of August 2024, the best guess that we have was yes. So we'll wait and see. Certainly what the Federal Reserve is doing in terms of dropping the interest rate, federal funds rate. Remember, the Federal Reserve, when they talk about the Federal Reserve lowers rates, they lower the overnight rate, the federal funds rate. However, by pure expectations, if the Federal Reserve says we're going to hold it at zero for a year, that'll definitely affect the 1 year rate and so forth. But what was I saying there? So what the Federal Reserve has started is the sort of abrupt decline in the federal funds rate, consistent with us going into a recession. So that's what the indications say, and we'll see. I'll leave you with, and I'll probably do a separate presentation on this, but because, again, this has a strong theoretical basis, and then we see it in the data, there's a lot of empirical methods that try to sort of quantify the extent of the yield curve inversion and translate that into a probability of a recession. So here's a paper that tries to predict recessions via the yield curve. I have some Python code here to pull the data and then calculate probabilities. These are old probabilities. So I may create an interactive app where this will be updated. But if you want, and you want to say, okay, well, let me start predicting recessions, you can use this approach. Again, the idea here is we are just looking at saying, okay, well, I think there might be a recession, right? I think there might be a recession. What this paper attempts to do is put that into I expect there to be a 60%, right, probability of a recession within a year. Right? So definitely give that a shot. All the code you need to generate this chart is right there. And otherwise, have a great day.